All right, let's jump right into this explainer. Today, we're doing a full financial checkup on US Bancorp, essentially taking what looks like a giant wall of numbers and translating it into a crystal clear story. If you've ever stared at a financial statement and just felt totally overwhelmed by the sheer volume of data, trust me, you are not alone. But today, we're cutting straight through all that noise. We're going to take the raw data for US Bancorp, ticker symbol USB, and break it down piece by piece so we can see exactly what's going on under the hood.
To keep things moving, here is our roadmap for today. We'll start with the big picture, figure out if the price is right, look at the power of their dividends, track historical growth and returns, and finally, assess the company's overall profitability and health.
Okay, let's kick things off with Section 1, US Bancorp, the big picture.
Right out of the gate, with a massive $82.4 billion market cap, we are talking about an absolute heavy hitter in the financial space. We're definitely not looking at some small, highly volatile regional player here. US Bancorp is an established giant. They've got the scale and the sheer size to basically weather the kinds of economic storms that might completely capsize smaller institutions. But, as we all know, just because a company is big doesn't automatically mean it's a smart buy. For that, we really need to look at the price tag.
Which brings us right into Section 2. Is the price right?
When we put the last closing price of $53.12 right up against the calculated fair value price of $64.28, well, a very clear discount emerges. And just for some quick context, this fair value comes from projecting the cash the business is expected to generate and then bringing that back to today's dollars. So the math is basically telling us the stock should be trading closer to $64, yet the market is handing it to us at just over $53. And that specific gap, that gives us a 17.37% margin of safety. Now, a margin of safety is essentially your financial shock absorber. It basically means that even if those future projections end up being slightly too optimistic or, if there's just some unexpected hiccup in the broader economy, you still have a solid 17% buffer built right into your purchase price. It's an absolutely crucial concept if you want to minimize your risk. Now, before we look at some other valuation metrics, let's weigh this price against their actual growth using the PEG ratio. It sits at a remarkably low 0.62. This is just a fascinating number. Usually, you're looking for a PEG ratio right around 1.0 to indicate a fairly valued company. So a PEG of 0.62, that strongly suggests the market is heavily discounting US Bancorp's future earnings growth. You are essentially paying a bargain price for the growth the bank is already delivering. But let's broaden the lens a bit. The current PE ratio of 11.14 is actually sitting at about a 4% discount to its 3-year historical norm. We always have to look at the full picture though, right? Because the price to free cash flow ratio is currently 8.61, which is roughly 6% higher than its average. And similarly, its price to book ratio, which is a super important metric for analyzing banks, is 1.26, so a roughly 5.4% premium over its recent average. So it's a nuanced picture for sure, but one that still leans heavily toward a broader discount when you factor in that big margin of safety we just talked about.
Let's move on to Section 3 and talk about a favorite topic for many investors, the power of dividends.
The big takeaway here is that US Bancorp isn't just offering a nearly 4% yield, which is highly competitive on its own right now. The real story is that they have consistently raised that payout for 14 straight years. That's a serious track record. And look at that 5-year compound annual growth rate of 4.36%. They aren't just stubbornly maintaining the dividend, they're actively growing it faster than the long-term average rate of inflation. And that is exactly what steadily increases your real purchasing power over time. And this chart perfectly visualizes how safe that dividend really is. They are distributing roughly 43% of their earnings to shareholders and safely keeping the rest to run the business. A high dividend yield is literally only attractive if it's actually sustainable, and this 43% payout ratio is pretty much the textbook definition of a healthy, sustainable dividend. It leaves the bank with about 57% of its earnings to reinvest in new tech, issue more loans, buy back their own shares, or just fortify the balance sheet for a rainy day. All right, Section 4, let's roll the tape back a bit and track their growth and returns. Looking at this timeline, you really get a story of dramatic market resilience. The banking sector is notoriously super sensitive to macroeconomic events. Interest rate hikes, global pandemics, you name it. In 2020, during the global shutdowns, the stock dropped almost 18%. But then it just roared back in 2021 with a 24% gain. Then, as inflation and rate hikes spooked the markets in 2022, it fell 19%, only to set the stage to recover all over again. It's definitely a cyclical ride, but it's one that has a very clear habit of bouncing back strong. And when we smooth all that volatility out into annualized returns, a really interesting momentum shift appears. So while the 10-year annualized return sits at a pretty modest 6.30%, look at the recent trailing 12 months. It's absolutely surged to an impressive 37.49%. The longer 10-year window shows us a steady, if somewhat slow, compounding rate. But over the last 3 years, that annual growth rate is over 25%. And that recent explosion to 37% tells us the market has aggressively started waking up to the intrinsic value we identified earlier.
Let's wrap things up with Section 5, assessing profitability and health. Let's really diagnose the underlying vitals here. Reading this like a medical chart, an ROE of 11.30% and a net profit margin over 16% point to a really solidly profitable engine. In the banking world, a return on equity consistently hovering above 10% is basically the hallmark of a highly efficient management team. And a return on assets of 1.07%, that's exactly what you want to see from a well-run financial institution. They're highly effective at taking their massive asset base and turning it into a 16% net profit margin. And they're doing all this with a debt-to-equity ratio of 1.20, which is perfectly normal and totally manageable for a modern bank.
Now, what's genuinely interesting here is free cash flow yield. This shows us exactly how much hard cash the business is generating relative to its price. Now, earnings are an accounting metric, and sure, they're important, but they can be tweaked with accounting adjustments. Free cash flow is the actual lifeblood of a business. It's the cold, hard cash left in the register at the end of the day after all the operating expenses and capital expenditures are paid. By converting that into a yield, we see the true cash return the investment is generating right now.
And here is the payoff. At an 11.64% free cash flow yield, U.S. Bancorp is producing massive amounts of cash, actually outperforming its own 9.01% earnings yield. This is a huge realization. Whenever a company's free cash flow yield is significantly higher than its earnings yield, it strongly suggests their earnings are of incredibly high quality. We aren't just looking at paper profits here. They are backed by real, liquid cash flowing right into the business. An 11.6% yield gives management immense flexibility to keep that 14-year streak of dividend hikes alive, buy back stock, or intelligently invest in future growth.
So, as we wrap up this explainer, I want to leave you with this question to chew on. Based on all the hard data we've just diagnosed, is the market currently undervaluing this financial giant? Think about it. We've walked through their $82 billion scale, that nice 17% margin of safety, a remarkably low PEG ratio of 0.62, and a perfectly sustainable 4% dividend backed by absolute monster cash flow generation. The numbers paint a very specific picture of operational health and, frankly, a very attractive valuation. The data's on the table, we've broken it all down, and now it's up to you to decide how to interpret this gap between price and value. Keep learning, keep analyzing, and I'll see you in the next explainer.